everyone. Welcome to the Financial Stability Report press conference. We're joined today by John Cunliffe, Deputy Governor for Financial Stability, Sam Woods, Deputy Governor for Prudential Regulation, and the Governor, Andrew Bailey. Andrew will start us off with opening remarks, and then we'll move to questions.
Thank you, Katie. Well, can I add my welcome to the press conference for the July Financial Stability Report as well. So before we take questions, I'd like to set out some of the key themes from the report, and also, of course, the announcement of publications that we're releasing today, because as you can see, there's a fair, as usual at this time of year, there's a fair volume of information that we've put out. So I'd like to start with a few points I'd like to draw out. What I'm going to cover is the key developments so far in this year in the global financial stability outlook, the judgments that the FPC has made on the resilience of the UK banking system, including obviously the results of the stress test, and the decision we've taken, as we always do, on the countercyclical capital buffer. Moving then on to the lessons we've learnt to date from the recent stress in the global banking system, and then finishing up on the continued importance of addressing vulnerabilities in the non-bank financial world. So on that basis, let me start on the key developments so far this year. So we've had obviously further rises in global interest rates, reflecting actual and expected increases in central bank policy rates. In the UK, returning inflation to target sustainably will, of course, support the FPC's objectives as well as the MPC's objectives, because it will support protecting and enhancing financial stability in the UK. Now, the increase in interest rates and market volatility over the past 18 months has, as we've seen, created stress in some parts of the financial system. And we did, of course, in March have the failure of three mid-sized US banks and Credit Suisse. That caused a rise in risk premia and volatility around March. But our judgment is that the impact of that stress in March on the UK banking system was limited, and that since then, globally, market risk sentiment has stabilised. And more broadly, the UK economy and financial system have so far been resilient to interest rate risk. Compared to previous periods of high interest rates, households and businesses are less likely to cut back on spending and default on loans. And I think there are really two reasons, important reasons, to draw out here for this. The first one is the resilience of the banking system. And that means that the banks have options to offer support to their customers. A more resilient banking system has more options in that sense to support its customers. And the second reason I draw out is that the FPC and the FCA's mortgage market measures have limited the build-up of household indebtedness and increased borrower resilience. So the 2 points I'm drawing out really are lender resilience and borrower resilience, and they of course go together very closely. But it is the case that elements of the global financial system do remain vulnerable to increased interest rates and uncertainty surrounding the economic outlook and, of course, tensions geopolitically speaking. And really, as we point to in the FSR, we point to riskier corporate borrowing in financial markets, such as leverage lending, as an area of vulnerability that has to be followed closely. Global commercial real estate markets, which face a number of short and longer term headwinds that are pushing down on prices and making refinancing more challenging in that world. And I think we do have to bear in mind that it will take time for the full impact of higher interest rates to come through, both in the UK and in other advanced economies. And so the FPC will remain vigilant to these risks and these processes taking effect. So let me move on then to the UK banking sector and its resilience and the stress test and the CCYB decision. So in the UK, we've taken steps over time, of course, to ensure that the banking system is resilient to these risks and that it maintains robust capital ratios and liquidity buffers. And the results of the stress test that we've published today show that the major UK banks are resilient to a severe stress scenario. That scenario incorporated deep simultaneous recessions with materially higher unemployment in the UK and global economies, increasing global interest rates, persistently higher advanced economy inflation, and sharp falls in asset prices. Now, I would particularly note that while interest rates are higher today and therefore closer to those which we published in the scenario, that is higher than when we first outlined the scenario is significantly more severe than today's conditions. And a very important point there is that it's the combination of higher interest rates and simultaneous recessions around the world and in this country, and materially higher unemployment that makes the stress. It's not one thing on its own. That's the key point I would bring out there. Second, we're announcing that the FPC has decided to maintain the UK countercyclical capital buffer rate at 2%. This will help to ensure that banks have sufficient capacity to absorb future shocks without unduly restricting lending. And of course, as ever, we stand ready to vary that CCYB rate in either direction, in line with the evolution of economic and financial conditions, underlying vulnerabilities, and the overall environment for risk. Now, we have observed some tightening of lending standards from banks over the past few quarters. But our judgment, and we have to make this judgment every time, is that that reflects appropriate risk management in line with changes in the outlook for the economy and the world. It's not a case of restricting lending primarily to protect capital positions, and it's that distinction between risk management and capital protection that is critical here. But of course, we will continue to monitor credit conditions for any signs of tightening which are not explained satisfactorily by changes in the macroeconomic outlook. So the overall risk environment is challenging, and that said, we continue to judge that the UK banking system has the capacity to support households and businesses through a period of higher interest rates. And that the stress test shows that that would be the case even if economic conditions were substantially worse than we currently expect. We move on to the lessons from the recent global financial and global banking sector stress. The recent stresses that we've seen in the parts of the global banking system underscore the importance of maintaining robust macroprudential, regulatory and supervisory standards. This is very much work in progress in terms of assessing the recent events, and the FPC will continue to draw lessons from this episode. I think that the episode has underscored how contagion can spread across and within jurisdictions, even where smaller institutions are involved. And it highlighted that while an individual institution may not be considered systemic in its own right, if a risk is common or perceived to be common among similar institutions, it's the collective impact that has to be assessed and can pose a systemic risk. Now, the PRA's regulatory framework here seeks to ensure that UK banks are adequately capitalised against the risks that they're exposed to, including interest rate risk. We will contribute to relevant international work and are doing so to consider whether lessons can be learnt for the liquidity and capital frameworks in light of the size and pace of the runs that we saw both in the US and Switzerland. I think crucially these events also demonstrated the importance of credible resolution frameworks and maintaining confidence in those frameworks. Over the weekend that Silicon Valley Bank's UK subsidiary failed, we conducted a successful resolution transaction demonstrating the effective operation of the UK regime. And in doing so, we were able to protect both depositors and public money. But working with the Treasury, we're now seeking to ensure that for small banks, which do not need to hold additional resources to meet what's called the MREL, there are resolution options that ensure continuity of access for depositors. The stress also demonstrated the importance of international authorities' commitment to ensuring that the resolution frameworks and plans for the globally systemic banks, in line with the standards set by the Global Financial Stability Board, remain credible. Let me turn to the resilience of market-based finance now. Recent events, as I've just said, brought risks in the global banking system into sharp focus, but there remain vulnerabilities in certain parts of the market-based financial system. And so there remains an urgent need to increase resilience in market-based finance globally. And alongside international work led by the FSB, the UK authorities are also working to reduce vulnerabilities domestically, where it is effective and practical. These vulnerabilities could crystallise in the context of the current interest rate volatility. The risks were evident in autumn last year when the stress in liability-driven investment funds required a temporary and targeted intervention by us. The ability of those funds to absorb shocks has since been reinforced through the setting of new standards. In March, the FPC recommended that the pension regulator take action as soon as possible to mitigate financial stability risks by specifying the minimum levels of resilience for LDI funds. And since then, both the FCA and the pension regulator have published detailed guidance on LDI resilience. We welcome this guidance and the steps taken by pension regulator and the FCA to ensure continued resilience of LDI funds. We will also develop our approach to monitoring these risks across market-based finance as the financial system adjusts to higher interest rates. And it's with that in mind that we've recently launched the system-wide exploratory scenario exercise, the first of its kind. The aim of this exercise is to improve understanding of the behaviours of banks and non-bank financial institutions in stressed financial market conditions. It will explore how these behaviours might interact to amplify shocks in financial markets that are core to UK financial stability. That's all I was going to say on the financial stability outlook, but I want to finish with two personal notes. The first one is that this is the last press conference where we'll be joined by John. John has served on the FPC and as the bank's Deputy Governor for Financial Stability for 10 years nearly, and he will have served for 10 years by the time he comes to the end of his term. And before that, for I think around 2.5 decades, John has been a public servant of the absolutely highest calibre. And our gratitude at the bank to John is only rivaled, I think, by that of other institutions in this country for which he has tirelessly and steadfastly served over a distinguished career. If any of you are present at international meetings, such as the IMF meetings, you'll know the standing in which John is held globally. Personally, I want to give a heartfelt thanks to John for his contributions, our discussions over the last decade and before that. We will miss John, but he leaves the bank with his ideas and energy, having shaped and inspired a very grateful institution. The final note, I'm afraid, is much sadder. Recently, we heard the news that our Executive Director for Resolution, Melanie Beeman, tragically passed away. Mel was a world-class bank supervisor, somebody I worked with for nearly 30 years, amongst the best bank supervisors I've ever met. She was also the life and soul of this institution, and we miss her greatly. Thank you.
We'll now take questions. Usual process, please. Once you get a hold of the microphone, if you could let us know your name and where you're from, and if you could limit it to one question, that would be great. We'll start with Ashley.
Thank you. Ashley Armstrong from The Sun. I just wanted to ask about the level of arrears. You say that, kind of we're going to have a shoot up, but it's not going to be as bad as 2007. Given that in 2007 we had a slightly different situation, now we've got inflation much higher that's eroding kind of basic income. Do you think that there's going to be a greater drift between the inequality of kind of socio-demographic groups than it was in 2007? Because it feels like the poorest are already being hit by inflation at this level, and actually those that are facing arrears will probably face even more difficulty.
Yeah, I might bring John in on this one, actually.
So there are some big differences between now and 2007. As you say, 2007 inflation was not rising and interest rates were going down, whereas at the moment we're seeing the opposite. I think the big difference is that the amount of household debt that's being carried is much lower now than it was at the time of the financial crisis. So households aren't really kind of over-levered as they were before. And that's one of the reasons why we think that households in distress, whose debt service ratios adjusted for inflation will reach sort of levels where in the past you've seen distress, that proportion of households will be smaller than we saw in the financial crisis and considerably smaller. I think it's clear that inflation hits the poorest off in society worse, and I think that's well known, and that's one of the key reasons why one needs to get it under control. But if we're thinking about mortgage arrears and the ability of households to pay, then I think the fact that households are carrying less debt than they were, and that's in part because of the action that the Bank of England and the Financial Policy Committee took to put constraints on mortgage borrowing, that I think will leave us in a stronger position in terms of distress.
I just absolutely agree with John on this. I just reinforce the 2 points I made at the beginning. we have a set of borrowers who, as John has said, are less exposed, and particularly less exposed at the sort of at the extreme tail. And secondly, we also have a banking system that is more able to support its customers. A resilient banking system is more able to support its customers, and that's a critical point as well. I mean, that's another critical point of macroprudential policy. The banks can support their customers and can support the economy rather than the other way around.
We've got Ed and then Kalina.
Hi, Ed Conway from Sky News. How can you reconcile the fact that, for a lot of people around the country, this feels really tough, with the fact that you have charts now saying that, in many dimensions, it's not going to be as bad as in 2008? Is that just about the distribution of the way that, the pain is being felt, or is it something else? And just a tiny kind of micro second question. Do you regret withdrawing the mortgage affordability tests in 2022? Would things have been different? I know they've probably improved the nature of those charts right now, but would they have been even more resilient had you actually left it in place for a little bit longer?
Well, I'll start off. I think 2 points on the first part and come on to the test withdrawal point. The first point, in a sense, the point is the point John just made, which is, what macroprudential policy, and particularly the mortgage, as you just mentioned, Ed, the mortgage policies that we adopted back, nearly 10 years ago now, actually, have done is that they have limited what I might call the number of people who are going to face, the extreme, pain and stress of this as a consequence. The second point I'd make is a macroeconomic point, that we do have, of course, much lower unemployment in this country. We have a much stronger labour market. We're having to deal with that on another front. But on this front, of course, it is helping a lot in terms of the stress that households are seeing. On the withdrawal of the test, the answer is no, actually. And the reason is, and the reason we withdrew the test is that we had 3 tests essentially applying at that time. So there was the LTI flow limit, as we call it, which is an FPC measure, which is still there. And then we had 2 affordability tests. One was the FPCs and the other was the FCAs. And the consequence of all the work that our staff did in assessing that is that the two affordability tests, and actually also the sum of the 3 tests, if you like, meant that we didn't need 2 affordability tests. One was doing the job. And that's why we withdrew the FPC one, because we felt that actually the combination of the FCA one, which has to be there under rules, and the LTI flow limit test did the job. So, from the point of view, we do obviously have a keen eye on regulatory efficiency. We felt that did it.
Kalina.
On that point, you are predicting that some households, around 1 million, I think, by Q4 2026, are going to see their mortgages rise by about £500. What impact do you think that's going to have, and do you think they can actually keep up with those payments?
Well, it is going to have an impact, clearly, and I have to be, put my monetary policy hat on for a moment. Of course, that is part of the transmission of monetary policy. No question about that. And I'll just come back to this point we've made a number of times. I think what we're seeking to do here, when we, and this is why the Bank of England has responsibility for both monetary policy and financial stability, excuse me, that we are trying to balance having the transmission of monetary policy with the 2 things I would emphasise. One is the resilience of the banking system, and 2 is the ability to support customers and therefore manage the consequences of this. But there will still be consequences from increased interest rates, I'm afraid, because that's from a monetary policy perspective why we have to do it.
Laura and then Jean-Paul.
Thank you, Laura Noonan from the Financial Times. Just a quick question about the efforts that are ongoing to try to encourage banks to increase their savings rates and to reduce their mortgage rates. Do you have any concerns from a financial stability perspective about those efforts? Like, is it a dangerous game to get into, telling banks to offer higher savings rates, telling banks to control their mortgage rate increases in this environment? Thank you.
Well, I don't understand what's coming. Let me start off with, I think, one big message from this morning, from what we've released this morning, which is that the resilience of the banking system is not a constraint on banks managing their net interest margins and therefore managing the rates they pay to savers and the rates they charge on mortgages. And that's important. There is not because it wasn't always the case in the past, as you know. It's very important that financial stability is not a constraint in that sense. So banks can take the decisions that they need to take on that front without having to, in a sense, restrict for financial stability reasons. And I think that's a very important thing. Now, in terms of saving rates, I'll make 3 points, I think all of which I've made before, but they're important to make. One is, it is the case, and we do draw this point out, that we've seen more pass-through in fixed deposits than we have in sight deposits. I'm not saying that banks can have no regard for sight deposits, but there is a reason for that, which is that particularly from the point of view of liquidity management for banks, fixed-term deposits have a value in that sense. We come back to the point about exposure to runs actually at that point. So there is a value to that. Now, it's not surprising that we've therefore seen customers switch deposits from sight deposits to fixed deposits. So that's happening, and that's not surprising at all. So I think that's an important point to bear in mind. A second important point to bear in mind is that there is what I might call a more structural rebalancing of rates going on as we move away from the zero interest rates. Obviously, when we went to effectively zero interest rates, if you go back to before the financial crisis, so back into the sort of time when we had rates more in the realm that we have them today, it was pretty typical for the average rate that banks paid on savings to be just below our official rate. When our official rate went down to nearly zero, that relationship reversed. And what we're now seeing is it re-establishing the old sort of order, if you like, and I don't think that's a surprising thing to see. So those 2 points, I think, are important as part of the sort of understanding the transmission. But I'll finish with the third point. It is important that obviously rates get passed through. I think it is also important that we have competition in the banking system, which encourages banks to compete and compete on saving rates. And again, just to re-emphasise, a more resilient banking system will be able to compete. I mean, again, they haven't got one arm tied behind their back by the need to achieve financial stability. They can compete on that basis, and that's a good thing.
Maybe just to add one very brief point, Laura, which is we have also explored that in the stress test. So in the stress test, we've done 2 things. One is that we've made the proportion of non-interest-bearing household deposits drop by 15 percentage points, people migrating more into term. That's more than the banks put into us and more than we've experienced so far. And the other thing we've done to illustrate Andrew's point is we've required the level of pass-through to be such in the stress test that the spread between sight household interest-bearing deposits and bank rate goes back down to the sort of level it was at in the 2000s, which is about 220 basis points, versus more like the 285 that we've seen recently. So we've made sure, as Andrew was saying, that the system is kind of capitalised and tested against a higher level of pass-through.
I think John wanted to come in as well.
Just a sort of macro point. I think the structure of banks' liabilities, deposit accounts, will change. And they changed after the financial crisis. I think a period of very low interest rates meant the proportion of bank liabilities accounted for by non-interest bearing deposit accounts grew, and the proportion of remunerated fixed-term deposits shrank. And what you're seeing now, and I think that's what you would expect to see as interest rates go up, is those proportions moving, and we're getting a greater move into more fixed-term remunerated deposits. And from a financial stability point of view, redressing that balance, that's a good thing, because as Andrew said, that's more stable funding for the banks, and you would expect them to want to pay more for that, and actually to bring us back closer to the pre-financial crisis levels.
They also get a benefit in our liquidity regime, which Sam operates, if they have more stable funding.
John Paul.
Good morning. I just wanted to ask, please, about the debt servicing ratio, so that the proportion of the post-tax income being paid in mortgages expected to rise to 8% by mid-2026. And that's going to be lower than it was in the 2007 crisis. Does that comparison, in one sense, or those kind of comparisons, give the MPC, in a sense, a green light for interest rate rises? But also, what is that rate going to be when it's just as a proportion of people who have mortgages? Is it? I've seen it said that it's more like 25% of their income is going to be spent on debt servicing, and how does that compare to the crisis levels? I'm not sure if you've done that in the report.
We may have to come back to you on that one. I don't know, John may know. I'll just take the MPC point and then hand on. Be careful about. I'm not going to use the green light analogy because obviously we're not giving any messages about what will happen to interest rates here. But what I would say is this: that obviously monetary policy and financial stability are sort of closely interact here. So that of course, the MPC has to have regard for the stability of the financial system and the stability of the environment when it thinks about its actions, and that's actually written into the operating sort of rules, and we do that. And so again, a more stable environment is one in which monetary policy can do its job. I mean, it's easier for monetary policy to do its job when it's operating against the backdrop of a stable financial system. And I'm just emphasising that's a very important point.
So I don't have a number.
Yeah, we'll come back.
But just as a proportion of that.
Yeah.
We'll go to Phil and then Bill, please.
Thanks. Phil Aldrich, Bloomberg. John, I think a year ago you suggested that interest rates at about 5% would start to cause problems for corporates and also put more sort of dangerously high levels of households in debt distress. It seems in this report today that 5% isn't causing undue distress among corporates or households. So what is the level at which we'll start to see problems? I just wonder if you could also explain what's happening on the LDI front. I understand that there was further recapitalizations. Were there billions more? And what's been happening on that front?
So, just on, I think what I said is there was a range. I think it was between 200 and 500 basis points, so quite a big range. So that would take us to an interest rate considerably higher than where we are now. One of the things that we've seen, though, I think over the last year, is actually through basically the support the banks are offering, through the ability to extend term, through the ability to change mortgage terms. I think that there are, we'll move on to interest only, I think, which is part of the Chancellor's package, that actually there are more options there for people to soften that. But the number we give in this report, and there's been some changes because we were talking also about not just mortgage payments but cost of living, trying to take account of both the impact of inflation and higher mortgage repayments, and we've tweaked the inflation numbers to add more elements of inflation in, which has made it sort of made the inflation pressure go up a bit. But the number we're giving now is about 300 basis points for that mortgage rates to interest rates to increase before you reached those debt levels, which are the levels we just talked about we had in the financial crisis. So we've seen that, shall we say, highly indebted number move from 1.6% of households to about 2%, but it would need to move up to about 3.5% to get back to where we were in the financial crisis. And the number we give there is about 300 basis points to get there. Yeah. But we gave a range last time. And you gave me the bottom end of the range, and I've just given you something close to the top end of the range. Do you want me to do the LDI?
I'll start on LDI. I mean, on LDI, what we've done, as I said, is that we've essentially sort of set what we think is a sensible buffer level for them to hold as a sort of, as a buffer against stress. What that meant was that when interest rates went up, there was no disorderly need to, in a sense, try to call down assets to recapitalise the LDI funds. That there was a movement of assets, but that happened in a very sort of an orderly fashion, which is what we want. The other point I'd make about that movement is, of course, that it's actually the case that when interest rates rise, the underlying position of pension funds actually strengthens, according to the accounting of the net asset value of pension funds strengthens. So it's not a question of what I call the underlying solvency of pension funds. It was the problem of the need to do this sudden and quite disorderly transfer of funds, which couldn't happen in the time available. So with the buffer in place, that problem is mitigated. Well, there will be some rebuilding of the buffer, but it wasn't that large actually.
Immediately after the LDI crisis, until we'd kind of worked out a more longer-term solution, we asked the funds to be holding about 300 basis points to be able to accommodate a 300 basis point shift in long-dated gilt yields. And they put that in place. They put it in place immediately after the LDI incident. We've since formalised that. And we in the last FPC round, we set out requirements for them to hold a standing buffer of about 200-250 basis points, and then enough to deal with market moves. And that pretty much is where they kind of were at the time, with the extra resilience that we put in immediately after the crisis. Some of that buffer has been used up as yields have moved, but as Andrew says, what the buffer is trying to do is to give them time to actually recapitalise, to get contributions from the sponsor pension funds. And the sponsor pension funds can do that because their liabilities are going sort of down in value faster or by more than their assets are going down in value. So this is really a question of how do you deal with an acute liquidity crisis. Second point, of course, is we've seen a movement up in yields, but I think during the LDI crisis, yields went up by about 150 basis points in 3 days, which was an unprecedented sort of speed, and that was being driven by other events. Whereas now we're seeing yields go up as the market kind of works out or re-estimates where bank rate will need to go to bring inflation back to target. So that's a more gradual adjustment process. So the combination of the fact that this is happening over a more gradual period and the fact they have the buffer to absorb it means that they've been able to absorb those increases in gilt yields without the financial stability stress that we saw back in September.
Bill.
Thank you. Bill Schomburg from Reuters. Just going back to the report, I think you referred to how the stress that we saw in the parts of the banking sector recently underscored the importance of international authorities and their commitment to making sure that the resolution framework remains credible. Can I just ask, did the way that Credit Suisse was taken over, did that affect the credibility of the global financial resolution rules on an international level? And secondly, seeing as you have put your monetary policy hat on a couple of times already today, and you talked about the labour market, what was your takeaway from yesterday's jobs report? Was it more of the signs of accelerating pay growth, or were you more taken with the signs of perhaps some weakness or some looseness coming into the labour market?
Yeah, well, let's start with Credit Suisse. Obviously, Credit Suisse, there was a resolution of Credit Suisse. Let's be clear on that. It wasn't a resolution that followed the sort of the playbook exactly. But of course, I mean, I should say that there is always some flexibility within the playbook, and you have to have that because we can't prescribe every situation that's going to occur. So I don't think that's the issue, and I'm not going to get into the question of sort of what happened, what didn't happen around the route that was chosen. What I think is important, and I've said this before, is that there were comments made that there was doubt cast on the globally significant bank resolution plans more broadly by virtue of not using the playbook and deciding that the playbook couldn't be used. Now, that's a very serious issue because if that is for two points I'll make here. One, we can't ignore that. I mean, we can't live with a world where there's ambiguity. That's just not, of course, acceptable. The risk is much too great. Secondly, we have to get to the bottom of the question, well, is this or is this not accurate in terms of the description of the resolution plans, which of course have come out of the work done in the Global Financial Stability Board and then implemented by all of us as national authorities. And that work is going on. The resolution committee of the Global Financial Stability Board, led by Marty Greenberg, is very focused on that. I will give, because I think I've said this before in public, I'll give you my own starting point on this. I'm afraid I do remain to be convinced that assertion that there was, that this cast doubt on these plans more generally is the case. I'm afraid I am not convinced by that assertion, but I am very convinced that we have to obviously kick its tires and test it thoroughly to decide whether these plans are still fit for purpose or whether we need to go back to them and change things. You just cannot, this is far too important to sweep that under the carpet. So that's my view of the position. Did you want to?
Just to say, I mean, some of that work at the international level, Financial Stability Board, looking at resolution in the light of Credit Suisse and in the light of the 3 US banks that need to be resolved. At the last meeting of the FSB plenary, there was a press notice, just gave some of the conclusions, initial conclusions of that, which was there was a viable and credible resolution option. So I think a better way to think about it is that the Swiss authorities had a number of choices. They happened to have a private sector buyer, although it came with other things as well, and they chose one route rather than the other route. But the fact they chose one route doesn't mean the other route wasn't a viable and credible alternative. And I think in some of the kind of heat and noise surrounding that, as Andrew said, perception may have grown that there wasn't a credible resolution alternative. I think the work and the work the FSB is showing is that though there are lessons to learn from Credit Suisse, as there are from Silicon Valley, etc., and the regime always needs to take account of actual instances, the credible resolution options under the international framework are there and can be used. And there won't always be a private sector buyer. So,
On the labour market, obviously it's not a monetary policy press conference this morning, but good try. The Monetary Policy Committee obviously hasn't, we'll be starting our round next week, actually. So what I would say, I'm just saying, I think a number of commentators have said this about yesterday's data, is that there are two parts to it. You can see that. I mean, I'll repeat what I said at the Mansion House, not for the first time, on Monday evening, which is the current level of pay increases are not consistent with the inflation target. I mean, that's, I'm afraid, a fact of life, and we have to deal with that. On the other side, when you look, and I think you were referring to this, when you look at the sort of the quantities side of yesterday's report, I think there are some interesting, pieces of evidence. They're not actually that newer evidence. I mean, it's a continuation in some cases. If you look at the vacancy to unemployment ratio, for instance, of some signs of the labour market cooling. And we do pick that. I pick this up, and we pick this up when we go around the country. Actually, you are hearing more stories. So, what I will say is, I mean, that's the job of the MPC. We're going to have to sort of put all this information together again and see what we make of it.
Tim?
Tim Wallace at the Daily Telegraph. Can you expand a bit more on the plight of small landlords? Are they facing a bit of a wipeout given the sharp rise in interest rates? And can you talk about the implications of this for house prices and for rents as well? And also, are there any, are we still seeing any help coming through for households from the pandemic savings that they built up? Are they helping people through the shock they're facing at the moment?
Sam, do you want to?
Yes, on the smaller landlords point, we're not very concerned by that from a financial stability point of view. We do include in today's publications an assessment of what we think the average increase in a monthly payment for a buy-to-let landlord would be likely to be over the course of the next couple of years, and we put an estimate there of £275 a month. Now, it is true that if everything else was held static and landlords had no ability to adjust any of their other incomings and outgoings, that would push a considerably higher portion of buy-to-let mortgages below a key threshold that we use in supervision, which is an interest rate coverage ratio of 125%, and it would actually increase that number from about 3% to just over 40%. But of course, in the real world, other things are not held fixed, and we have actually seen over the last year around a 5% increase in rents, and that is a product of the pressures that landlords are facing, at least in part, partly from, of course, change in financing conditions, but also other pressures that they have. So we expect the situation to continue to evolve in that way. We've included a number also of the net sales coming out of that part of the market in terms of properties, which is actually a relatively small number of 100,000 in the context of the overall housing market. Only other point I would make is that we do, of course, stress test all that in our stress test. And we do stress buy-to-let mortgages. We think they have a higher impairment rate in our stress test than others. But overall, if you look at mortgages, it actually goes back to the earlier question as well. We think that the impairment rate that we'd see in mortgages in our stress test, which is a much worse version of the world than the one we are actually in at the moment, would only be 0.9%. And that's actually down from 1.6% last time we did that. And that's because the quality of assets has improved in the meantime, not least because house prices have gone up, and therefore the portion of these mortgages, which has a high LTV, is pretty low. So I'll finish on one point to illustrate that, which is that the stock of buy-to-let mortgages, 94% of them have an LTV of less than 75%.
I might just make a sort of a general point on that, which two general points. I mean, one, there's a lot of other things going on in the buy-to-let market. There have been taxation changes, there are new environmental standards, there are changes to the structure of tenancies and how tenancies, how you can end tenancies. Okay, so there's a lot of other things apart from interest rates. But the more general point is we've come out of a period of very low interest rates, and the percentage, the proportion of small private sector landlords grew during that period. And now we're in a period of higher interest rates where there are other returns in other parts of other sorts of investments. And you would expect that there will be some rebalancing as we move. And it's the same point as the rebalancing of deposit accounts. One would expect those flows. From a financial stability point of view, the question is, does that happen in a way that can be accommodated? What's the impact on the banking sector? And as Sam said, the net outflow, when you look at the larger landlords coming in to the market, is not particularly large at the moment. But I think we should expect as we go through this period that people will change their investment preferences because the relative value of different investments, changes.
I think that rebalancing was already happening, just consistent with John's point about other factors before interest rates started to rise, actually. So, yeah.
Go to...
Sorry. Well, I think you're right. I mean, I think that the build-up of saving, and particularly the build-up of unexpected saving beyond what you would expect during the pandemic, does provide some buffer in that sense. Yeah. Obviously, by the way, of course, the real value of that saving has come down, but it does provide some buffer. Yeah.
Dave, and then Coe.
Thank you, David Robinson, Market News. Following the footsteps of the New York Fed, do you place any weight on the idea of double R-star? There is a policy rate at which you create financial instability. I noticed that Catherine Mann referred to it recently. And if you do attach weight to that, are we above it or below it?
Well, I'll start off. I mean, I think you'd have to ask the question why, what is the underlying reason, why you take rates to whatever level it is. I would caution against merely running a simulation and a model and saying, what if we put rates to, pick your number, what would happen? Because you'd have to look at the underlying reason. I mean, this is the point, where things come from a number of answers to a number of questions. We've got a higher interest rate today but in a very different context to the one we see in the stress test. So you have to take that, in terms of what breaks it, you really do have to take that into consideration. So you've got to specify I think the sort of the scenario very carefully to do that type of analysis, because you'll get different answers for different scenarios.
Yeah, maybe just a sort of general point stepping back. So the economy will go through different cycles over time. There will be an interest rate cycle. This one has been fast by historical standards, but in terms of the amplitude of the cycle, actually not so very different. The job of financial stability is to make sure that when that happens, the financial sector has the resilience to deal with it. Or first of all, to make sure the financial sector doesn't cause it, which is what happened in 2008. But even if it doesn't cause it, that it has the resilience to deal with that, so monetary policy has the freedom to operate. And that, in a way, is what the stress test is all about. So it posits unemployment at 8.5, 5% recession, etc., and says, can the banking system deal with that so that monetary policy does have the freedom to operate to do what is necessary to bring inflation back to target? And I think that's a more helpful way of looking at it than saying, in a model somewhere, is there a rate that breaks this? Do people lose money when economic circumstances change? They do, and actually it's a function of markets in the system that should be part of it. But the question is, can the financial system adjust to that change without falling over in the way that we saw happen 15 years ago? That's in the stress test and the judgment that's in this FSL.
I mean, I just emphasise this point that I think historically, slightly at the risk of what I said on Monday evening about we always understand life backwards, unemployment is one of the best guides to impairment in the banking system. That's been the case in the past. Obviously, we've had very big spikes in unemployment in the past during recessions. That's why you see a very different situation today. But then again, as John just said, a stress test in which we've tested with a level of unemployment that's just over double what we've got today, and the system is resilient to that.
I'm Kohei from Nikkei. So thank you. So yeah, as Governor Bailey said, March, so BOE took a decision that HSBC bought UK subsidiary of Silicon Valley Bank by £1. So what lessons can you withdraw from this exact whole event, whole processes for future financial crisis? And do you think the Banking Act 2009 is effective through this exact experience?
Well, I think there's a number of lessons I take from that weekend, but we were all closely involved in it, so we'll all have our perspectives. But let me draw out three things about that weekend in the context of Silicon Valley UK. One is that in the UK system, we have, for quite a long time now actually, required, as part of what we call Pillar 2 of the capital system, slightly the intricacies of Basel. Basel globally is Pillar 1, and then Pillar 2 is things that you choose to implement nationally. We've implemented what we called interest rate risk in the banking book, capital requirement. That's important because that covers whatever risk banks are taking through, as we saw with SVB globally, this capacity to have an interest rate mismatch in the banking book. And so we've always, for a long time, required banks to hold capital against that risk, and there's a stress test used to, in a sense, calibrate that interest rate risk. That's the first thing. I mean, I think that is important. And I think the second thing is, and I'm going to be quite careful what I say here because it's been covered. It is the case that Silicon Valley Bank UK subsidiarised about last year, actually. I mean, it was actually about a year ago, wasn't it, Sam, actually, I think. And that's because it was approaching the sort of the policy that we already have in place as to at what point we think it makes sense for a bank to subsidiarise in the context of how many effectively insured or FSCS eligible deposits it's holding. Now, I just want to be careful here because things have been written about this. Of course, we're doing the lessons learned. I just want to say it doesn't mean that we're about to enact some radical change to the subsidiarisation policy. I think it was a particular benefit to us in this case because, frankly, if we hadn't had it, we couldn't have done a resolution. The FDIC would have been doing it. So of course, because we always review these things, but I just want to be very careful that we're not cooking up some radical change. We're just looking at it and saying, how did it work? I think the third thing I take from it, and here I'll be quite open about it. I think the first two things I've set out meant that we had a resolvable entity. We had something that you could resolve. I think the thing was, in the UK end, looked to me certainly to be basically solvent and resolvable. And that's, you've got to have that really to get into the process. If you're talking, here I'm talking about resolution in terms of transfer and sale to another party. The third thing then you have to have is a party that wants it. And we had it in this case. You can't always rely on that. I've done quite a few resolutions in my time, and they don't always work like that. But put those three things together, and it came together. But what we're doing is saying, well, okay, so that was very good and helpful. But we have to look very carefully then and say, what do we learn from that in terms of messages we can take? And that's what we're doing. Yeah.
Maybe I could just add just two brief points. One is, I think the events that have taken place in the US banking system are a useful reminder of the way that contagion can happen within a banking system. We had very limited contagion into our own system, only really through wholesale funding costs and bank share prices. But it's a reminder of that and something to be aware of. And secondly, just to go back to a point that Andrew had mentioned earlier, we feel we had a very successful resolution of Silicon Valley Bank UK. And from a standing start on a Friday morning to a Sunday afternoon, we had 3 different options that we could have taken. And that's a good place to be, much better than where we were, say, 10 years ago. So that reinforces the confidence that I have in that part of our toolkit. But as Andrew was saying, you need to learn from these things. And there is a question, do we want to broaden our toolkit to have some more options for depositor continuity in smaller firms? And that's something we're working on.
Chris, and then did you have one more? Yep.
Hi, Chris Dorrell from City AM. I guess I was wondering that generally it seems that risks emerge in quite unexpected places in quite concentrated ways. And I take all the points that this scenario is testing, high unemployment, inflation, global downturn. What can it tell us about risks that emerge in very specific markets, say in commodities, and where the changes that take place very quickly, and how can banks prepare for that?
Well, I'll start. I'm sure John and Sam want to come in. 2 things I'll say on this. One, in constructing the scenario for the bank stress test, we do look more broadly than just the sort of core UK markets. So you'll see from looking at it, for instance, that we've obviously once again had to think quite carefully, for instance, about risks in China and Hong Kong, because obviously our major banks are very active in those markets, much more so than often other sort of major banking sectors elsewhere. So that's an example of something we always look at carefully, because we have the exposures in that respect, and so have to look at them very carefully. We also look very carefully at something at areas like, for instance, leverage lending, because it's another, we've highlighted again in this report and have in quite a few previous ones. It's an area where we do think there is more risk. Commercial real estate would be another one. So those things we do. Second thing I'd say is I'll just move on to the market-based finance test, the exercise we're launching. Because I think it's that your question is really very relevant to this, actually, which is how, I've said before, I think one of the big challenges with the non-bank world is that it's a very big landscape, quite diverse, as you said, and also we've found by experience that sometimes the problems can emerge in quite opaque and slightly obscure parts of that world. And so the challenge that we have to set ourselves, both here and globally, is how can we sort of, in a sense, get our arms around that efficiently. And the exercise we're launching is very much as I see it, is a learning experience to say, how can we take this forward now and actually, put this into practice? Because it is, it is a challenge. I mean, you mentioned commodity markets. You can, I mean, in a sense, LDI, which I've said before, it wasn't the major part of the LDI industry where the particular problem arose. It was in the so-called pooled funds, which are only probably about 15% of the LDI market. So, these are substantial challenges and ones that we know we've got to sort of get our arms around. And so the exercises, again, in the market-based finance world is a big step forward in how we can actually do that effectively.
The dash for cash that we saw in March 20 is actually quite illustrative of that. We know that there is what I would call fragility in market liquidity under stress. So we've seen jumps to illiquidity over the last few years in a number of instances. And some of that is to do with the way in which the system interacts. As Andrew said, market-based finance, much more diverse. And I don't think the FPC has a regular horizon scanning exercise where it looks at that. We're trying to improve that. We have the system-wide exploratory test, which is essentially a test of how the market works together, coming up. But we know that there are some areas where, if you like, liquidity stress gets amplified and transmitted across the system. Money market funds, open-ended funds, impact of margin call in stress, some of the hedge fund strategies. These things have been well identified over the last few years. It's an international issue because these markets are kind of international. You can't really solve much of it domestically, but there is work going on in the FSB. They've just brought out something on open-ended funds. We've got improvements on money market funds. Where in the UK then we'll be putting out our proposals later on. There will be proposals coming, I hope, on margin. So there are things we can do, but we really have to act internationally, try and reduce that liquidity fragility, because we've seen when the system works together, you can just amplify liquidity stress where problems go. But will we always know everything that is happening in those markets globally? I think that's going to be very difficult.
I mean, just emphasising what John said, if you go back to March, one of the things, particularly in the US, you saw was a flow out of banks into money market funds. Now, that emphasises the fact that money market funds are, an important part of the system, and we've got FSB proposals out there, but they've got to be put into effect.
Andrew, maybe I could just add one point, which is when we talk about the stress test, we tend to focus mainly on the real economy variables, but we also have a very significant traded risk stress. The banks take a £30 billion loss, and in amongst that, the banks are required to default 5 of their uncollateralized counterparties and 2 of their largest collateralized counterparties. So I think that gets to the sort of risks that you were asking about.
Ed?
Hi, sorry, just another quick one. So correct me if I'm wrong on this, but looking at the stress test, it does look like some of the ring-fence banks did particularly well. I just wonder whether, is there a lesson from that, given, the talk about the Edinburgh reforms, given, people are looking at this right now? Is it a warning of the resilience of the current system and a warning about messing with that system?
Well, I'll take that one from me. Thanks, Ed. Look, I think by far the most striking thing about the stress test is, in fact, that the capital drawdown, in other words, the capital hit, is really quite a lot smaller than the last time we ran a test of similar severity. So it's a 3.5 point drawdown versus 5.2 last time that we did this. And within that, you're quite right to observe that the ring-fence banks even have a lower drawdown. That is good news. That is a product of changes we were talking about earlier in terms of asset quality. It's also things like some of the legacy books from actually, still with us from before the financial crisis, having got smaller and rolling off since then, and some changes in lending standards since. So I think that is good news. But what you do see, though, of course, in the ring-fence bank results is sort of what you'd expect, that the effect of the scenario on the ring-fence banks is a bit more homogenous than the effect on the banks overall, and you would expect that. But that is obviously something we have to have an eye to. It is, of course, very important that we are stressing those banks to things that could really happen, because there is more of a possibility, naturally by design, if you like, that the ring-fence banks' results could be more similar through time.
All right. we'll do Phil and then Bill, and that's it.
Thanks. Yeah, Phil Aldrich again. Just on uninsured deposits, I think you sort of touched on the fact that resolution regimes are being looked at. There's been talk about turning the FSCS into a recapitalisation fund. There's been talk about pre-funding the FSCS as part of these reforms. I just wonder where we are on that and current thinking.
Yeah, and look, I'm not going to say prejudge where that's all going to end up. You're right, we're looking quite broadly at it. I don't, by the way, think the answer is just to raise the limit. The 85,000. I mean, there may be a case for doing something at 85,000. I'm not going to prejudge that for a moment. But the answer is not to raise the 85,000 in this case. And in a way, that was one of the lessons, I think, or one of the messages from Silicon Valley, UK, which was that actually what it had was some very lumpy corporate deposits, which were the working capital of companies. I mean, they were, it was the lifeblood of these companies, and we were very aware of that from the messages we got over the weekend. So I don't think just saying, well, if we put it up from 85 to some other number that's larger than 85, that doesn't really do it. So we are looking, as we said, more broadly at the resolution toolkit, if you like, as Sam was saying earlier. To say, how can we address that question? Because I think, the point that did come across that weekend, to be clear, was that in the corporate deposit world, these accounts are, of course, so much the lifeblood of how these companies operate. So I think it does make it clear that we have to look at that afresh and say, what can we do? But I think the answer, if it probably lies in the resolution toolkit rather than the FSCS limit world.
The Treasury has spoken to and reached agreements with banks about ways to minimise forbearance in the mortgage market, also other ways to help people who are struggling perhaps with their mortgage costs. On the other hand, the Bank of England is using interest rates to execute monetary policy. How close are we to a point where the two institutions are almost working at loggerheads? And is this something that you discussed with the Treasury around the time that they were talking to the banks about what they could do to make mortgage costs more bearable for people?
Well, we're not at loggerheads at all, actually. I think one of the things that the Monetary Policy Committee has to do is understand that obviously the transmission mechanism of monetary policy is an important part of monetary policy setting. And so understanding that and understanding how it's changing. And of course, in the mortgage area, it's changed a lot since we last, it's 20 years really, since we last had a rate rise cycle. So the shift to a predominantly fixed rate market, and then the question of how the process of resetting rates actually works is an important consideration for the MPC, but we're not at loggerheads. And I'll just come back to a point I made, I think, very early on that, just from a financial stability point of view. I mean, it is, I think, very helpful to have a banking system that can support its customers. I don't think any of us want to go back to a world where the rate of repossessions of houses, if you go back to the early 90s, for instance, the recession of the early 90s, the rate of repossessions that was there, and obviously the effect that has on people and on families, we don't want to go back to that world. And I think we're in a much better place with a banking system that can support its customers and reasons. So we're not at loggerheads. I think it's a matter of understanding the impact of these measures.
Thank you very much, everyone.
Thank you.